After delivering strong earnings across the board, Microsoft lost $350 billion from its market cap. That's like acing your finals. Then your professor tells you they actually graded on a curve that he made up in his head. It's emotionally confusing. So today we're analyzing three things. First, what happened with earnings. Second, how Microsoft's long-term returns stack up against the market and its big tech peers. Third, the real reasons the stock is down, and whether Microsoft is overpriced, fairly priced, or undervalued right now. By the end, we'll figure out if the market is too emotional or it's reacting to the expectations baked into the stock long before this earnings call. Let's begin with the simplest paradox in investing. Good news can feel like bad news, if everyone already expected it. Microsoft reported earnings with revenue around $81.3 billion and a strong profit beat, including cloud revenue solidly above expectations. On paper, that's a great quarter. In reality, the market yawned, then sold. This sell-off was based on cloud business expectations. Microsoft's cloud growth, especially Azure, came in strong but not stellar at exactly the level investors had already priced in. The stock market is not a scoreboard of last quarter's performance. It's a scoreboard of next quarter's expectations. If you deliver what everyone already expected, the market reacts as if you missed something. So when Microsoft beats and still slides, it's often because expectations were already dangerously high. Now let's get rid of the emotions and look deeper into the quality of Microsoft. In the last 5 years, returns are well above the S&P 500's performance. But who cares? The market has shifted from pure growth mania toward profitability and clarity of AI monetization. And that shift has compressed valuations for even strong operators like Microsoft. So while the S&P 500 keeps grinding higher with diversified engines under the hood, Microsoft's stock reflects a single theme, AI plus cloud. And when that theme gets scrutinized, the price gets volatile. Now let's look at Microsoft versus the Magnificent Seven. Over the last 5 years, Microsoft sits in 5th position as far as performance. NVIDIA, Alphabet, Meta, and Elon have all outperformed Microsoft. When the narrative centers on AI leadership, and one stock is perceived as the safe version rather than the moonshot version, investor capital rotates toward what feels bigger, faster, louder. Why long-term investment feels like short-term pain? Microsoft is spending big money on AI infrastructure. Truly big money. Reports indicate capital expenditures in the quarter surged by 66% to about $37.5 billion. That spending is mostly building out massive data centers, buying expensive GPUs, and scaling AI capabilities. The problem with that is, these are investments, not income. For investors who've been trained to love short-term margin expansion, this feels like bleeding cash, even when it's laying the foundation for dominance. Investing is about the future cash flows, not applause for last quarter's numbers. But AI is weird, because the future promised is so appealing that even massive spending feels justified, until it isn't. And right now, the market is saying, this spending isn't paying off fast enough. This is the crux of why Microsoft is down. Not because earnings were bad, but because Wall Street is asking for proof of future profit growth from AI and cloud infrastructure. So investors got emotional and took off running. But not everything new and exciting brings immediate profit. So where does that leave us? Is Microsoft A, overpriced, B, fairly priced, C, undervalued? Here's the honest answer most investors don't want to hear. Microsoft is priced for perfection, but not punished for weakness. It's fairly priced in the long run, overpriced for short-term narratives, and undervalued for long-term compounding vision. Let's unpack that. The stock today reflects record earnings beats, strong cloud plus AI revenue, enormous CapEx commitments, cautious investor sentiment. That's a lot of moving parts. And the current price is a market consensus that reflects the tension between optimism and scrutiny. Is it overpriced? Only if you're a trader. If your time horizon is weeks or months. If you demand immediate ROI on AI bets, then yes, the stock feels expensive because the market is repricing expectations, not fundamentals. Is it undervalued? Only if you think long-term. If you believe AI isn't a fad, and Microsoft's build-out will translate into persistent cloud and enterprise revenue. If you believe in moats that tilt the field over decades, then today's price might look like a discount on future dominance. Analysts remain bullish, still rate the stock as a buy, and are predicting a significant upside.